I'm Neetha Bidway, and this is Good Revenue. Today, we're going to talk about planes, trains, and automobiles, a new European stock exchange, and AI updates. As always, you can find links to everything we talk about in the show notes. Hit the subscribe button if you haven't already, and thank you for joining us. The average price of a new vehicle is officially over $50,000, according to the Kelley Blue Book. Year over year, prices are up 3.6%. That's the largest gain since the spring of 2023. There are three drivers of the cost increase: tariffs, no surprise there, the expiration of the electric vehicle tax credit, and also the fact that more luxury cars are being sold. Kelley Blue Book says that luxury vehicles over $75,000 in price have risen from 6% of all sales to 7.4%. And the average price for an electric vehicle is now over $58,000. All of this is happening at the same time that China is aggressively flooding global markets with low-cost electric vehicles, particularly Europe and Latin America, as well as some in the Middle East. According to the latest data, 222,000 cars were shipped in September 2025 by China, electric vehicles, and the total from the first half of the year is over 1 million EVs exported, which is also a first for China. Now, the Chinese have some issues with this in terms of the effects on their own domestic markets. And we've talked about this in prior episodes. We will link to that here. But it's helpful to keep some of the context that the reason that they are flooding markets is because they have a domestic production problem, meaning they are producing way too many cars in China. And therefore, they're dealing with the problem of cut rate pricing, and it's causing a lot of other issues across their economy. Now, the big takeaways here: wealthy buyers are doing well and they're driving the market. But unfortunately, auto loans are at 7.6% for new cars and 15% for used cars, as we've mentioned before. And the other part of this that's really bad news is, according to Fitch Ratings, subprime loan defaults are rising. This is not a good sign for the wider economy. If you didn't love that update on cars, this next one on planes may also be a little dark. Almost 1 in 4 flights was delayed in 2024, according to data from AirHelp. So it's disappointing to learn the Department of Transportation has canceled cash compensation refunds. It was a requirement in the event that airlines actually cause delays or cancel a flight. In the prior administration, they had been required to actually provide you cash as a refund. That is now going away. Some other things that the airlines are asking for, which seem likely to come to pass under this new administration and this new Department of Transportation, they are also likely going to take away rapid refunds, which means that you'll only have a voucher with the airline. You won't get your money back. Second, upfront pricing is likely going to be far more convoluted. Lately, airlines have been forced to undertake what's called all-in pricing, meaning before you buy your ticket, you have to actually get the full price, which seems pretty reasonable. But airlines don't love it. It makes it harder for them to sell a ticket when the total price is really high. So unfortunately, we might expect more junk fees and less disclosure before we have to buy a ticket. Next, there are fewer protections for disabled passengers. If you're someone who needs to bring a wheelchair onto a plane and that wheelchair is damaged by the airline, they are not going to take care of the cost of that anymore under a DOT policy. And in addition, if you have relied on family seating policies to make it easier to sit with your children, that is also going away. Finally, you can expect to see less public disclosure of data. So less data on things like on-time arrivals. Not great. Airlines are understandably happy about this, but consumer groups and advocates are pointing out that the airlines took more than $54 billion from taxpayers as part of COVID relief. There was also an extension of loan guarantees and a reduction of taxes. So there were a lot of taxpayer benefits that were extended during COVID. And unfortunately, it doesn't look like consumers are going to get a lot of ROI on those investments in the short run. The other challenge that is being pointed out by a lot of advocates is that in the United States, we have a dearth of competition. We don't have a ton of carriers in the US. And so unlike markets like the EU, where they have lots of carriers and lower prices, we have fewer carriers and higher prices. So get ready for that next time you have to buy a plane ticket. On the train front, Union Pacific and Norfolk Southern are expected to move forward with their $85 billion merger. If this goes through, it will be the first transcontinental railroad in the United States. It's been approved by both of their boards, and last month, the largest railroad union said yes, and you can expect to see a shareholder vote in mid-November, on November 14th. Now, if this is completed, it'll be 50,000 miles of rail across 43 states, and it's expected to close in 2027. Union Pacific has been spending a lot of time talking to its customers, but one of those customers, the third largest one, is the chemical industry, and they are unimpressed by this deal. They're opposed to it, and they are asking for something called reciprocal shipping, which means that if they request that their goods be moved to a competitive railroad, the carrier has to agree. Stay tuned on this one. We'll see what happens and if that is something that they're able to negotiate before this deal closes. Let's turn to Europe. The German chancellor has proposed that Europe have a single integrated stock exchange. If this were to go through, it would be one of the biggest changes to the financial markets in Europe in decades. A single exchange would be a really big change from the state of play today. There are 78 global exchanges. 30 of those are in Europe. There are another 13 in the United States, and we're expecting one more in Texas next year. Now, the largest exchange in the world is the New York Stock Exchange, and the NYSE paired with the NASDAQ really have made New York the center of the financial world. Now, Europe's goal in trying to put this together is to reduce the fragmentation that they see across all of their member states and all of those exchanges. They'll also have access to larger pools of capital. So stay tuned. Let's switch gears and we'll move into our AI segment. So today, let's talk a little bit about AI hardware. First off, US AI chips are meeting a real milestone. Nvidia just announced that they've produced the first Blackwell chip wafer at the TSMC plant in Phoenix, Arizona. This architecture is their newest design. It's supposed to be 25x lower energy costs as opposed to their earlier chips. So that's a really big deal too. Now, the way this process works, the manufacturing is domestic, meaning it's in the United States, but the final packaging still has to happen in Taiwan. So these chips have to be shipped to Taiwan before they can actually be used. Nvidia is planning to spend $500 billion along with partners over the next 4 years. It's supposed to create hundreds of thousands of jobs. And if you want more context and detail on semiconductors, I recommend reading Chip War by Chris Miller. Really interesting book, and it has a lot of great detail and history about why the semiconductor industry is so fragmented, and particularly why is the supply chain as distributed, let's say, as it is globally. It's really interesting, and it really feeds into a lot of the geopolitics that we have been talking about on this show. Next, Walmart. Walmart continues to be a really interesting case study when it comes to AI. Their latest achievement appears to be that they are finding a great use case for AI hardware. Specifically, they're planning to deploy millions of battery-free ambient Internet of Things sensors, that's a mouthful, in their supply chain. Now, this is better than the RFID technology that Walmart heavily invested in 2004. And the reason is that these battery-free IoT sensors don't require the same energy load and they're cheaper. So therefore, there can be many more millions of these deployed across the inventory and the supply chain for Walmart. Now, they're expecting that this will allow them to monitor 90 million pallets by 2026, which is just a huge amount of data. And that would effectively give them real-time inventory rather than their probabilistic model, which is how they manage that inventory today. So if this actually comes together, it's a huge achievement for them and likely a great case study for other companies that are trying to figure out how to really drive business ROI from AI. However, one thing to keep in mind that they haven't fully cracked the code on, there are a lot of security risks, cybersecurity risks associated with Internet of Things devices. And so one thing to maybe keep an eye on here is how they'll manage that over time. Final story, The cloud market in AI continues to be just a fascinating and massive amount of money. Globally, the cloud market is projected to exceed $400 billion in this year, so in 2025. It's growing 25% year over year, and that's fueled by generative AI, as we've talked about on almost every episode of this show. AWS, Azure, and Google Cloud are collectively planning to spend $240 billion in 2025 on data centers and AI infrastructure. And I say this all the time, but we talk about billions of dollars like it's $35 in your wallet. It's just unbelievable. But that's $250 billion almost in just this year on infrastructure. So lots of money at stake. The problem that they have that they still have to solve for is that these high-end AI chips don't have the same profit margins as other parts of the cloud business. And so the area to keep an eye on, I think, is whether or not these margins are going to make sense over time. And there's some great reporting in the information, which we will include in the show notes. That's all we have for you today. As always, thank you so much for joining us, and we'll see you here very soon. Thanks for listening. If you liked what you heard, leave us a review, subscribe to the show, or check out another episode. We appreciate your support.